All right, welcome everyone. Let's get started. Hopefully you guys can hear me okay. So today we have a riveting topic. Basically going to give you an update on the fiscal stimulus. So the bill that was just passed by the House and the Senate and signed by the President. So we're going to spend the majority of our time there and just kind of going through some of the highlights. There is a little bit of, I guess what I would call code, meaning tax code policy changes that I'll spend a little bit of time on, just kind of going through. As always, from a housekeeping perspective, if you have questions, please type them in to the Q&A section. And I think there's going to be a little bit more of a concise presentation today. My guess is probably around 30 minutes where I go through a lot of these slides. Welcome everyone. I'm excited to cover this topic with you. It's been something we've been waiting on to understand what the stimulus bill was going to look like. So it is finally passed. So let me go ahead here and share my screen and get things going. All right. So the fiscal stimulus update. So March 16th, 2021. So one of the things that we've obviously been noticing from the economy is it's been recovering really since the depths of the economic fallout from COVID. And we've seen things starting to come back. Obviously, what's everyone's calling the reopening trade, which is basically getting back to some normalcy. Vaccines are helping us move along, but the economic upside is definitely improving, and it's pretty remarkable. I mean, we're now 1 year removed from the shutdown, and it's pretty amazing the kind of volatility that we've had, the kind of individual pain that we've had, family dynamics that have obviously this has been a really hard environment, business failures. I mean, it's really been a tumultuous 12 months. Really something that we've almost never seen in our country's history, especially kind of over this really short, tight period. I mean, we could go back to maybe the Great Depression as an example of kind of that immediate pain, but that pain lasted for a long period of time. And so when we look at what's going on today, we had a massive fiscal stimulus that was put in right at the outset of COVID to really stem the fall, to stem the panic, to stem things from continuing to unwind. But then, now we're 12 months removed. Things are, for the most part, I would say, maybe let's say 70% of Americans are back to some normalcy in terms of work and their livelihood. Unfortunately, there's still 20 to 30 that are still experiencing massive changes because of the shutdown of their businesses, things of that nature, and obviously impact on the health of their family. And so when you look at kind of this economic data that I have here in front of us, we're looking at the growth forecast. And so right now, actually, Raymond James is projecting that we're going to have 5% growth here in the US. And that's really unheard of. We haven't had a 5% growth year in a long time. It's going to be the best economic growth that we're projecting since 1984. So, pretty dramatic upside. But, you look at the chart on the right-hand side, that's following a massive decline. So it's usually normal that you have that level of correction and that level of bounce back after a really tough economic environment, which is what we went through last year. Vaccines. So we know vaccination cases are continuing to skyrocket, or excuse me, vaccine delivery is continuing to skyrocket. We're vaccinating 2.9 million people per day, which is pretty crazy to think about that number, 91 million doses to date. So charts below just kind of give you a little bit of a layout of where we are in terms of the number of cases, which is the dark blue line on the right-hand side, or excuse me, on the left-hand side, and then total cases, or excuse me, total vaccinations, which is the light blue. So you can see the massive spike up. And obviously that's, I think, breeding some confidence in the economy getting back to normal. And even here in California, in restaurant dining has opened up, effective, I believe it was yesterday or Sunday. And you can see again the daily vaccines that have been administered. And then the far right I thought was interesting, kind of the rollout of who are candidates for the vaccine. And clearly we've kind of started with those that are higher at risk, the healthcare professionals, long-term care facilities, individuals over 70 years old. And then kind of going down the list of essential workers, and then dealing with over 65, and then healthy adults, right? So this is kind of the rollout phase. And so That obviously is breeding more confidence, because obviously if we get some what we call, I guess, herd immunity, we'll get to a point where we can truly open back up and get back to some normalcy, maybe with some limitations and still some distancing, mask wearing, but at least get back to some normalcy in terms of our daily lives. So that's just kind of a brief update on what we're seeing now. Hopefully this is okay to see. It's always dangerous to do white lettering with a colored backdrop, but hopefully you can see this okay. So this is our road ahead for the fiscal stimulus in terms of what this looks like. And let's talk a little bit about what this bill was. So the Biden administration basically knew that it had to put together a big deal post-election to really get things moving, and they had to do it through budget reconciliation, and the bill was signed into law. So when we start looking at, well, what's in the bill, we're going to spend a little bit of time high level, but basically the bill is a $1.9 trillion economic relief package. It does have some emphasis on vaccination, some individual relief, small business support, also helping with some state funding. And the programs that are, I guess the stimulus is put in place to kind of mirror the programs that were put in place and expand the relief that was basically that would mirror the $3.5 trillion that was passed in 2020. So this 1.9 trillion coming this year is on top of the already $3.5 trillion passed in 2020. And I've been on record in previous webinars to talk about the fact that where we are in this in the COVID cycle, for lack of a better term, I thought we were at a point where we needed a little bit more of a rifle approach, meaning really focus on individuals, on industries that were still suffering, versus this kind of, I guess we could call it like a shotgun approach, right? Where you just kind of try to tackle everything. And with this plan, as the two that were put in place by Trump, it's still definitely much more of a shotgun approach. And I would have liked to see more of a rifle approach, but nonetheless, this is what we have. So let's deal with a couple of the nuances, some of the changes, because these were some things that had to get changed last minute because of lack of support. And these were also some things that were maybe the Biden campaign had run on in terms of policies that he was hoping to put in place. And so you can see here, let me get a pointer. You can kind of see over here where we're going to focus. So they did remove the $15 per hour minimum wage. That's definitely not off the table, but it's not part of this bill. And so there's a lot of push to get that removed and have it as a standalone debate. So that got moved off. They also, they changed some of the, I guess we can call income phase outs for individuals. So they made some adjustments in terms of if you make too much money, or if you made too much money in prior years, that they were going to cap out the benefits that you can receive. So you can see some of those notes there. And so they also, some of the changes, they did earmark about $10 billion for infrastructure. And then they also put in, a special provision that says no taxation on student loan forgiveness over the next 4 years. So if student loans are forgiven, or any student loan debt is forgiven, then you're not going to have, there's be no taxation on that debt forgiveness. So the one reason why the markets have been doing so well and still kind of rallying over this past week, and I know there's been a lot of volatility, which is normal, is because I think the stimulus was bigger than people expected. And while there's a lot of people concerned about the long-term impact, or maybe the inflationary pressures that might come, because of the size of this, they know it's going to be highly stimulative to the economy, because when you put money in people's pockets, they tend to do two things with it. They're going to spend it, or they're going to invest it. And that tends to help two things. Number one is spending drives the economy, because our economy is, over 70% of personal consumption. And then investing, obviously, if as investors put more capital into the financial markets, that will drive up prices, which moves the markets higher. So, so that's one of the reasons why there's a little bit of excitement out there. When we're looking at some of the key plans, and I tried to boil this down into just some, I guess we can look at some higher level items. What I think was a bit surprising was the items for the COVID response. So of the 1.9 trillion for COVID directly related response, it's only 83 billion, right? So if you do the math on that, that's less than 5% of the money is being spent for testing and tracing, treatment development, and vaccine distribution funding. So Then you can look at where the bulk of the money came in was in individual support, as well as public and private sector support. So some of the items on here you can see just kind of laid out is individual payments. So there's stimulus payments coming in to the tune of $400 billion. That's going to be $1,400 per person, child, and dependent. That will be subject to the income screening, and I think I have that on the next page. They did also extend this federal unemployment support, which is $300 extra per week. So as an example, if you're in California on unemployment, getting the maximum unemployment of roughly $420 per week, and then you add this extra $300 on top of that, that's $720 per week. That estimates to just roughly over $40,000 per year. So that's going to provide a pretty healthy cushion for people who are out of work. And then you can see some of the other items on here, like expansion of the child tax credit, some housing assistance, things that they had to put in place where they knew there was some pain and provide some of this support. And then you can see at the bottom of this page, dealing with state and local aid. This was a big point of contention between, I guess, the Republicans and Democrats is like, where should this money go? Should it be going to help state and local governments? Is it necessary? And you can see that's a pretty healthy number that went out, as well as education funding was $170 billion. A lot of the pushback that we were hearing, and yes, it was more on the conservative or Republican side, was around that, hey, this money is not like immediate, it's not emergency. Some of this money is going to be spent out over multiple years, and that they thought, okay, let's focus on what's needed today and let's put our efforts to that. But one of the things when you try to get a bill like this passed, the more you put in it, the more support you get, right? Because you make a lot more people happy. And on the flip side, you can also make a lot more people upset about the decisions that were put in place. So we recounted some of the high level items on here. And just to note, this will be available offline. So I did want to spend a little bit more time on just what this will look like. So one of the things that's pretty fascinating is that over the last, let's say, 4 years, I've been reading more articles in the Wall Street Journal. There was also a politician on the Democrat card last year. I don't recall which one, but really talked about universal basic income. And so this universal basic income is this idea of, if you are an American, if you're a citizen, you just get a check for the government. And that check basically is your support. And if you see actually how much money is getting paid out, this kind of top bullet point here. So with this American Rescue Plan, which is what this is called, a family of 4 with a household income below $150,000 will receive at least $14,000 in federal support this year, $11,000 of which will be directly deposited in their bank account. And so we've been hearing a lot of like, can we test universal basic income? You're not really seeing a lot of the proponents talk about this, but this is essentially what they're doing, is saying, okay, does something like this work in a society that is very wealthy? Are we going to get to a point where, automation replaces workers, robots replace workers? Are we going to get to a point where technology replaces a lot of jobs? And then will we put in place universal basic income? Now, I might be getting ahead of myself on this conversation, but it is pretty fascinating on how much money is going to go out. This money, I think one of the things that, maybe to our detriment, we like to spend money as Americans. So this money is going to find its way. Any of you have been in the market to buy a home? If you've been, looking to, I guess, invest any of your capital, prices of things are going up. And the big reason is because there's so much money out there. There's so much cash that's slushing around. Just think, between these 2 stimulus bills, the last year was 3.5 trillion, and this is another 1.5 trillion. So, this is going to have a very stimulative effect in the short term, and it probably will be long lasting. And we'll get into some of the repercussions of that, because that's been a dialogue that I've had with a lot of clients. Is they're concerned about what this means for the long-term health of our nation and what this might mean for inflation, interest rates. And so we will touch on that today. You can see, let's see if there's any other issues we want to come down here. So you can see these are a lot of these things that got passed, that got put in this bill. This is definitely going to be a big part of the 2020 midterm elections, in terms of, did you get past what you wanted to have passed? Did this meet your requirements in terms of what you wanted? And so that's going to be a big part of the political probably debate that we're going to be, I guess, either fortunate or unfortunate to have to observe over the coming years. And then I think a lot of more progressives were unhappy that they did not fight for this $15 minimum wage. So we'll see what kind of plays out on that front. But I know that was the big part of the disappointment, especially on the Democrat side. With that was that the $15 minimum wage did not get put as part of this bill. So the other thing is when we start looking, okay, so we're getting all this fiscal relief, and then it's like, okay, now what? Infrastructure, right? So the whole idea with infrastructure is let's rebuild America. We know we have a lot of aging cities that need to be rebuilt, roads need to be rebuilt, and we also have potentially a large part of our workforce that's out of work because of the permanent changes that COVID has made. And so putting together the necessary infrastructure bill. Now, this bill was part of, coming out of during the Obama administration, infrastructure spending was part of, the Obama administration agenda, Trump agenda, and we haven't really seen the full force of infrastructure spend. But one of the interesting things that, infrastructure this time might not just be the roads and bridges, right? It might be things like, and you can see on here, modernization of the economy, tackling climate change, addressing racial and economic inequalities, such as like universal broadband, which means getting everybody access to high-speed internet. Investments in the workforce, kind of mandated paid sick leave, things like that. So, it's not just the hard infrastructure, it's kind of the infrastructure, which is really the fabric of America. And we can debate what right or wrong, but the one thing that we know is with the Democratic Party in control for sure the next 2 years in terms of all parties, they're going to be able to advance that agenda to make some of these sweeping changes. And obviously, if these are changes you want to see, this is a great time to be able to look and see the changes that might come. And, we also have the flip side of, people who are worried about what this might mean. So kind of an interesting thing is this idea of return of earmarks. I think a lot of us have maybe been frustrated by the political process and this whole idea of just adding earmarks, adding things to all these bills so you get more and more consensus around voting. And there has been, they basically struck a deal to allow the limited returns of earmarks. So starting to add more earmarks back in. So if by doing so, it's probably going to help pass this, a new infrastructure bill. So that's what's going to be on the agenda. So remember, this fiscal relief did have infrastructure spending, but not to this degree. And you can see the proposal where we might see at the bottom here is pretty staggering: $1 to $4 trillion of full infrastructure spend. So we're getting to some real numbers. I don't have an example of this, but if any of you have either seen $1 trillion written down on paper, meaning the amount of zeros, it's pretty staggering how many zeros there are. If any of you want to go through that exercise, actually write it down. There is a lot of zeros. So we start getting to those big numbers, I definitely get a little bit lost. But we'll see what's going to happen here. And, we have seen interest rates come up. The 10-year government bond started the year below 1%, and it's moved up to over 1.5%. And I think that is a reflection of, by us putting this money into the system, a big form of where we're, a big place we're getting that money from is obviously borrowing that money. And that could put some pressure on interest rates going a little bit higher. Okay, so let me see. There is a question here. Let me just do a quick little check. Okay, so we got a question. The stock market is doing well. This seems like the roaring 20s. Should we be concerned that the bubble may burst? Okay, great question. You are now testing me, though, to figure out if I have a crystal ball, correct? So one of the things when you start thinking about, I'm just going to move this down here. When you think about the stock market, so yes, things have gone higher. We are at what we call maybe a little bit more elevated levels than normal, just based on historical data. However, if you recall last month, I talked about, what the market is overvalued, maybe relative to what, or valuations are relative to something else, right? So if you go to the bank right now, you can't make more than 1%. So there's still a lot of individuals, a lot of investors that still think there's value in the stock market. And so getting back to your question more specifically, will this end like the roaring 20s? Maybe. I don't think it'll end in a following up to like a Great Depression, because I think we have the economic engine and the policies and procedures in place to guard against that. But the one thing we do know about markets is they tend to go through these boom and bust periods, right? We tend to go through these periods where markets can get ahead of themselves and then they correct, and that's kind of the natural state of an economy. So I think instead of being afraid of that, you're aware of that, and that's why diversification is so important, right? That's why we balance portfolios, is so that if things get out of balance, we bring them back into alignment, so that if we do get to a state of market overvaluation, that you've properly prepared for that. So, we do think, and I stand by this, that this next 8 to 10 years for the economy is going to be quite strong because of all the innovation. And, a lot of the stimulus money in here, while it will likely cause probably some inflation, we don't think it's going to cause hyperinflation because technology is still driving the cost of a lot of things down. So there are always things to be concerned about, but I think there's almost too much hysteria on this. I think there's too much negativity, and we are not overly concerned about it. But and being good stewards of your money and of our money, we want to make sure we're keeping an eye on it, and obviously are trying to do a good job on managing that and managing risk. So hopefully that answers a bit of your question in terms of what our thoughts are. But we do think this is going to be an innovative decade, and so we are not currently concerned with that. So let's deal with some of the policies that we are looking at here. So you can see these are some of the tax implications that have not been passed yet. So this is only policy right now, but we are looking at what the proposals are, because now that we put this massive stimulus in place, we got to figure out how are we going to pay for this. Is this going to be through taxation? Is it going to be through printing money? Combination of both, which is probably the answer, but how are we going to pay for it? So I don't want to say the easy move, but one of the proposals is on the top rate is move it from 37% up to 39.6%. So that's just back prior to the Trump tax changes. That was the tax rate during the entire Obama administration. 39.6% is the highest federal rate. So that's likely going to happen. Payroll taxes. So this is a potentially a really big one. So you can see payroll taxes is 12.4%, which is split between employee and employer, that's the 12.4% is the Social Security tax. And what they're proposing is to tax more on households that have annual income greater than 400,000. And you can see the amount of revenue that would generate over 10 years. So that would be pretty significant. And so for high earners, so let's call it over 400,000, that could mean that on additional 100,000 of income, they're paying 12,000 more in tax. That means if someone goes from 400,000, and let's say they're making $1 million, that means on that $1 million, they're maybe paying an additional 75,000 of tax just on this tax change alone. So it's certainly geared towards taxing the higher earners, and in some cases could be quite punitive. So we obviously know there's Americans that are earning well north of $1 million, but if you look at some of this tax proposal in particular, that could be a pretty massive hit to their take-home pay, which, albeit at a higher rate, but that's an area that that's a massive change. That's a big capital gain change, or excuse me, a big tax change. As we go down this list, capital gains and dividends. There is a proposal. So you should all know that capital gains and dividends are taxed at lower rates than ordinary income. So there's a 0% bracket, a 15% bracket, and a 20% bracket on the federal level. So there's proposals that if you earn over $1 million, that instead of having this special rate, you're going to be at ordinary income taxes, which means above $1 million, you would be at 39.6%. So essentially that would be like raising your capital gains tax from 20% to 39.6. Now, mind you, that's above $1 million of income. So most of you on this call, especially my retired clients, you have north of $1 million of assets, but you don't have north of $1 million in income. So this is not going to impact that many people, but it is going to impact a lot of potential business owners. One of the trends that we're seeing, and we're in this, we provide advice to a lot of business owners, is that as they get ready to retire, part of their retirement plan is selling their business. So prior to these, I guess in anticipation of these changes, and looking at, let's say last year, as a combined federal tax rate, they might be right around 20 to 25% if they sold their business for 5 million or 10 million. And now if they sell it for those same numbers, that their tax rate might jump from 20 to 25 to 40 to 45. So we're talking about a much bigger tax liability. Estate taxes, so lower the threshold from roughly 10 million back down to 3.5. Maybe remove the step up in cost basis. That's going to be pretty unpopular. So part of the tax code we should all be familiar with is that when you leave your assets, excluding IRAs, so you leave your assets to the next generation, whether that be your spouse, whether that be your children, they get a step up in basis, right? So it doesn't matter what you paid for your house. The value of your house when your children inherit is basically your date of death. That's the same for your stocks, for your mutual funds. So if they eliminate this step up in basis, that means that children would inherit assets and actually have to pay tax based on what you paid for it. That's challenging for a few reasons. Number one is it's a big tax liability. Number two, there's a challenge around that because how do they have the records to prove what you paid for, right? It's a lot harder to prove. That's why the step-up basis, in my opinion, was put in place, because it was kind of a nightmare for the beneficiaries to figure out, what did you actually pay for this? So this remove the step-up in cost basis. I definitely could see the estate tax lower the threshold. The removing of the step-up it would wreak havoc with accountants, with the IRS. I don't even know if they have a way to really manage that, but I maybe look at that as a low probability event, but anything is possible. And then SALT, so this is state and local taxes. So right now, that was essentially capped at 10,000 based on the Trump tax changes. So they're talking about finding a way to manage that so that the full tax deductions for individuals can maybe get back to writing those, getting those deductions. So I don't have a lot of confidence in this. It's gonna be interesting on what's gonna happen with tax policy because the Democrats have the majority in basically all three branches, or the House, the Senate, and the presidency. They're going to be able to kind of push through some changes based on the priorities. And so we're not sure if this is going to be all of them, but this is kind of the stuff that's on the table up for conversation. But there's going to be plenty of Democrats that are going to view some of these as very punitive to a lot of their constituents. So there's still going to be a battle. This is not going to be just a simple party line issues, and really, there's going to be there will be a lot more infighting because these tax rates have significant ramifications for taxpayers. I'm not going to spend a ton of time going through corporate tax rates, but they're talking about increasing the tax rate back to where it was about 5 years ago. They are talking about, putting some new provisions in for 401ks. They're talking about, this is, I think, good news for retirees. Right now, your required minimum distribution age is age 72, and they're talking about moving that up to age 75. And then right now, the penalty if you don't do it is 50%, meaning if you're supposed to take out 10,000 and you didn't do it, the penalty is $5,000, 50%. So they're talking about lowering those penalties. One of the things that I think kind of came out of the GameStop and all the craziness going on with the short selling and things that hit the financial, actually hit the regular media regarding the stock market was all the GameStop craziness. And I think this is probably going to drive potentially this financial transaction tax, which basically would tax transactions. So buying and selling. So I don't like this idea because I feel like buying, people who are buying and selling, you're paying tax on the transaction, and then plus you're going to pay tax on the gain, right? So this is a tax that I think is going to be borne by all investors. They are talking about, do we exempt that from retirement accounts? That gets to be a big challenge, but this is definitely something that politicians have been trying to fight on, is like, how do we get a transaction tax put in place? And I hope that doesn't happen, because that's really just a tax across the board on all investors. Excuse me. So the one thing that is the biggest debate is the timing debate. We are in March. So the longer this tax policy change drags out, the question becomes, is this going to be phased in, or is it going to be put in place for next year, right? So is this going to be a 2021 policy or 2022? The earlier it gets done in the year, I have confidence that it's probably going to be a 2021 item. The longer this goes on, it's likely it won't be retroactive. And so, but we'll see. We don't know. Most of the accountants that I talked to kind of right before tax season, their idea was, hey, we think it's going to be 2021. We got to prepare for it, but we just don't know. So if it's retroactive back to Jan 1, obviously that means that we can't do any tax planning to deal with this, right? So if you're going to sell a business, sell a house, sell highly appreciated stock, if it's retroactive, it's already too late. Whatever tax policy is going to be put in place, that's the policy we're going to deal with, and there's not a whole lot we can do. All right. Okay, so this is just a The question that I get after I always talk about the fiscal stimulus, the printing of money, the borrowing of money is, well, what's going on with our budget? Isn't this going to be a problem? Now, I will have to, I guess, give a little clarity as to my answer on this is always a strange one. It's, well, it should matter at some point, but it hasn't. I remember even early days, I think in history class, in high school back in the late 80s, hearing about how much debt we had, and that's when we were under $1 trillion. And I think by the time Clinton left office, from basically George Washington through Clinton, we accumulated $1 trillion of debt. That's the building of America. That's what we had, about 1 trillion. Now, I might be off a little bit, but we had about 1 trillion. Since then, over the last 21 years, we've accumulated, almost 30 trillion, and you can see all this new. So obviously it was not an issue back in the late 80s, even though the media loved to talk about it. It's certainly becoming a bigger issue, but the question is when's this really going to matter? Because up until this point, it hasn't. And so some of the data that I have up here is just to kind of show you where our target federal budget is. This is not dealing with a stimulus though, right? This is just a normal budget. The concerning part is down here in the bottom right. So when you look at kind of percentage of debt, that's what concerns individuals. So you can look here, getting us out of the depression, we had debt that ran up to about 100% of our economy. And you can see that's essentially where we are right now. So that's kind of a line where, do we want it to start to turn down? Obviously, that's helpful. However, does that mean economic pain? One of the things that stimulus does do, whether you're for it or against it, it's putting money in people's pocket. It's money that can be spent on food, on necessities. It can also be spent in other ways, maybe just for fun. But that's one of the things it does provide stimulus and a backstop for individuals. But we all know that's not sustainable. At some point, you have to pay for it. What economists, analysts can't really agree on is what's that threshold? What's the threshold where now it is too painful? Because I've been hearing this along the way. I've been doing this back since 97, and our debt has always been a problem. Well, if it was a problem 20 years ago, then it should really be a problem now, and it just hasn't surfaced yet. We do think that's going to probably start to change, but maybe not as painfully as people think. So one of the questions that we've been getting a lot of is this idea of, well, rising interest rates is going to be bad, and rising inflation is going to be bad. Well, it all depends on how high. A lot of maybe let's call it baby boomers and older generations, they remember the 70s. When you left the 70s and in the early 80s, mortgage rates were at 15, 16%, when the prime rate of interest hit over 20%. When inflation was running, for a year about 20%. So that's what people are remembering. They're remembering that pain that it caused the economy and trying to look forward and saying, okay, is that what we have on the horizon because of all the printing of money? I don't believe that is the case because we have so many deflationary factors built into our economic system right now, technology being the biggest driver of that. And then the second biggest driver of that is our lack of dependence on oil, right? We now have a renewable energy, which is bringing down the costs. And so that's changing the whole landscape of inflationary pressures. So getting back to this idea on rising interest rates, so we have seen rising interest rates go up. But if you look at some of the data on here, over the last 30 years, there have been 11 rising rate environments, and we are currently in one. Rates have started to come back higher. Of those, nine of those 11 periods, we saw the market generate positive returns and annualized performance of over 16%. So I'm not sure what the future is going to hold, but what this would suggest is that rising interest rates is not necessarily a bad thing. But if you read a headline in the paper, read a headline on the internet, you would think like the world's coming to an end, and that's just simply not true. Now this time might be different, but we don't think just because rates are going higher that should be cause for alarm. If anything, for our retired clients, if rates go a little bit higher, that means you can earn a little bit more money on some of your guaranteed accounts, like your cash and your bonds. And right now, those are at extremely low levels, which makes it hard to live off of. And so that just wanted to give you kind of a highlight there. And then this is just a little bit of, where are we today? So this top chart basically shows the categories. So many of you might be familiar with this idea that the market's kind of broken into different segments, right? You have large companies, you have mid-size, and you have small. These are all companies that are valued in the billions of dollars and up, and even in Apple's case, north of $1 trillion. And they're also broken into what's called growth and value companies, and then blend. Blend's kind of a mix, so not growth, not value. And if you look at last year, large growth performed up 38%, where large value was up 0.8. And the big divide there is that growth tends to be healthcare and technology, and value tends to be, in this example, let's say energy and financials. So that's what last year looked like. Now, coming into this year, everyone's super pumped on technology again, healthcare. And while we think those businesses are quite healthy, the market valuations are stretched in those areas. And so look at what's happened just this year. So this is as of Friday. You can see the change. So small value, which last year was only up 4, is up roughly 28%. I was actually surprised to see that number. And large growth is flat. So in a year like this year, we're looking at a little bit of what we call a sector rotation or a style rotation. And it's just a reminder about being diversified. Energy was one of the worst places to be last year. Year to date, it's up 41.8%. Financial is one of the worst places to be last year. Year to date, it's up 18%. It's a terribly short window, but it's just a good reminder of the benefits of diversification, the benefits of asset allocation, and the benefits of rebalancing. And rebalancing basically means is, you own a broad portfolio, and when the markets are moving, bring them back into balance by rebalancing. It's not continuing to overweight your winners. It's actually taking profits from your winners and buying those that are out of favor. And so this is just a good reminder of some of the discipline that we have here at Vance Wealth to make sure that we're managing the money appropriately. And again, this is a terribly smart window, so I don't want to have you feel like, okay, this is something we look at every single day, but it's definitely trends that we want to look at over the course of months and years. And without further ado, this gets me to Q&A time. So let me just check in here and see if I have any questions. All right. And please, I have no questions. So hopefully I'll get some questions. I do see we have about 29 people on today. So I'd love to hear from you if you have some questions. I wanted to keep it kind of short and sweet because I want to do these every month. I want you to keep coming back. I'll give you kind of a quick moment here to maybe get a question in. All right, well, no questions today. So if you have any questions offline let's see, I got one. So just saved by the bell. So I'm going to go ahead and answer this question, and then we're going to wrap up. So thank you. Our next webinar, let me see if I have that on here. I do, will be Tuesday, April 20th, and then Tuesday, May 18th. So go ahead and mark your calendars if you have not done so already. These are the upcoming ones. And if you want to stay in touch with us through Facebook or LinkedIn, please like us on Facebook and connect with us on LinkedIn. And we got a couple questions. Perfect timing. Okay. So one question is, what are the steps for the potential tax increase? And I think probably that question is like, maybe what can you do regarding this? Because we don't know whether the tax changes are going to be retroactive, it does put us a little bit in a holding period, right? We're now in March, so if there are things that you're doing to maybe take advantage of current taxes, what we don't know is this going to change, and then anything you do today, you might actually come back to haunt you. So I think some of it is being patient. Most of our clients are long-term investors, so it's not we don't have to just buy and sell stuff just for sake of buying and selling. We can stay more disciplined and kind of try to manage the tax situation to the best of our ability. And some of the we didn't even get into the weeds on like the estate planning, but if they change the estate taxes, I mean, if you're in your 40s, 50s, and 60s, it's probably not super relevant because we've seen estate taxes change so much over the past 30 years that they'll probably change again in a new administration. But anybody who has where anybody with family that might, that might be towards end of life and is dealing with potentially passing in the next 2 to 4 years, that might have real economic impact on the family. Now, we can't do much about that at this point. Hopefully some planning has been put in place, but it's a really challenging scenario because we just don't know. So I think it is a little bit of wait and see. And we're such a proactive firm where we want to get out ahead of stuff. It's just really hard right now. So we did do a fair amount of tax planning last year because we kind of knew this was on the horizon, especially after Trump lost. So we did do some changes, and we did some tax planning at year end, but we couldn't take into account everything, right? There's only so much tax planning you can do in any one given year. All right, another question is, thanks, that was a great question. Do you think cryptocurrency will ever become stable enough to be added to a balanced portfolio? So good question. So we're seeing a lot with cryptocurrency, right? Investments like Bitcoin. There are plenty of investors that believe that crypto is kind of a must-have. People are starting to use it maybe as a gold alternative or a currency alternative. I do think it will become stable enough to get added to a portfolio. It probably will come in place more with some regulation because right now that market is definitely in flux and fairly new. So I think it probably will be. You're already seeing some big people like Elon Musk with Tesla and companies like Square and PayPal, they're adding that to part of their portfolio. So it will become the norm. I think at this point for us, we just don't have our comfort level around that yet. And so it's not part of it, but it's definitely going to be part of the future landscape. The timing, I don't know when. Let me just see here. I got another tax question. Just want to make sure. I got another tax question just to clarify I guess my response to that question was just trying to understand like what the process is and how fast this can be enacted. So I don't really understand the whole legislative process to pass tax reform. I know there's been some chatter of just trying to push through tax reform. I've read some articles on, will Biden put together like an executive directive to just say, this is what we're going to do. I don't think he has that flexibility in his decision making and his policy making. This will likely take a little bit more time because right now think about the COVID relief, the fiscal relief that was just put in place. I think that took longer than people expected, and there was a lot of wide support for kind of a big, powerful, expensive bill. This next one with tax policy is going to be probably fought a lot harder. But the challenges they have is we have all of these goals to spend money, to get money out to individuals, but where's that money going to come from? And so that's going to be a longer, drawn out decision. So I don't really know the process, but I do think tax policy decisions, especially if they're doing a sweeping tax reform bill, that it's going to take some time. If they try to chunk it up and say, okay, let's talk about estate taxes. Let's talk about income taxes. Let's talk about minimum wage. If they had those kind of productive conversations, I think we could actually make a lot more progress. The problem is we know the legislative process is they like to lump it all together. It's how you get more consensus and more support. But I would love it if they just started to tackle each at a time instead of trying to lump everything together, because you might agree with estate tax changes, but not agree with income tax changes and might agree with minimum wage changes. But when they lump it all together, it's kind of, you got to vote for everything or not. And that's unfortunately, I think, one of the flaws in our system versus taking each idea, separating it out, addressing it, having a conversation, and then making changes. So we'll see what happens, but I'm sure we'll know more. I don't think we're gonna have tax changes by next meeting in April, but my guess is we'll probably have some clarity by June. So stay tuned for our next webinar. Depending on what happens in the world, we'll make sure we make it timely. And if you have any topics you want us to cover, let me know. Thank you. Have a great night.